Hi, everyone. Welcome back to the Future of Finance podcast. I'm your host, Marissa Wood with Union Financial Services. And today we have an exciting episode ahead. We're diving deep into a topic that's really making headlines right now, stirring up opinions, and to be honest, confusing a lot of people. And that is the One Big Beautiful Bill. Now, whether you've heard it talked about in the media or not, it really can have a big impact on your day-to-day life, especially for families and working professionals. And to help us break it all down, we're joined by Todd Manternach with Excel Wealth Management. And Todd is an expert in financial policy and has over 30 years in the industry. So Todd, welcome to the show.
Thank you, Marissa. I'm very happy to be here.
Todd, tell us a little bit about how long you've been in the financial services industry. How'd you get started? Kind of what your niches are.
Yeah, well, I started in 1987 with Prudential Insurance Company. And then in 2002, I started my own business, broke off from Prudential, started my own financial planning business, and have been doing that ever since.
And where is Excel Wealth Management located?
We are in the wonderful state of Iowa, right in the middle of the country.
Nice. Gotta love the Midwest.
Oh, absolutely.
And you are really an expert when it comes to diving deep into those financial policies that most people don't want to read or learn about because it's just overwhelming. And you've been helping bring some clarity to your clients and to other advisors throughout the country. So today I'm going to call on you for your expertise on that.
Okay, thank you. I will try and do my best.
All right. We're going to break it down in a way that the average person can understand because legislation can be overwhelming and complicated and confusing, but it really does affect all of us on a day-to-day basis. And so we need to know what those impacts are going to be. And so for listeners that may not be following every headline, can you just explain what that one big beautiful bill actually is in plain English?
I will try and do my best when it comes to plain English. The main thing that the bill did is it made the 2017 Tax Cuts and Job Act, the lower tax brackets, permanent. Now, keep in mind when we say permanent, that means until Congress changes it. Doesn't mean it's permanent forever. The other thing it did, it provided some additional breaks for working Americans in certain types of jobs. It also brought in some additional breaks for those over 65 and to small business owners. I
Mm-hmm.
think today let's focus more on the individual and not on the business side. But in my opinion, it truly is one of the largest tax breaks for the middle class than we've seen in a very long time.
Wow.
And
Okay.
in the United States, middle class, if your income is between 52,000 and 155, you're considered middle class. And I think this bill does a lot to benefit that segment of the population.
Well, that's great. So basically, that 2017 tax cut was going to expire if this bill didn't get passed, correct?
Absolutely. And if that were the case, we would have seen major increases in almost everybody's taxes. The
We don't
rates would
like
have went
that.
up, the brackets would have went up. It would have affected a lot.
Okay. So, in terms of the average American family, how will this affect things like taxes, childcare, healthcare, student loans? Are there any standout impacts that you're seeing for the average family?
Yeah, when we talk about especially young families, the child tax credit, we're seeing an increase on that. So it's going from 2,000 to 2,200. They're also increasing the amount of refundable credit. And what that means is if you don't pay enough in taxes and your credit exceeds your taxes, you get that back. So you can actually get a refund that exceeds what you paid in. So that's being increased from 1,600 to 1,700 per child. But one of the other big changes is they've made it inflation adjusted. So it used to be Congress always had to go in and increase this. Now it's going to automatically increase just by the inflation rate. So that's one of the
Okay.
pieces that's really big. The other is they've increased the phase out. So for a single person, this credit doesn't start to phase out until you're at 200,000 of income. And for
Mm.
a married couple, it's 400,000. So this is truly going to benefit an awful lot of people that maybe may not have been able to receive that in the past.
Okay, so those with children are going to be positively impacted on their tax bill.
Yeah, and it goes even further when we look at the dependent care tax credit. So that's if you've got a child going to daycare, you get some tax breaks on that. So here again, this is
Okay.
going to allow a larger percentage of people in that middle class to get a larger break if they have children in daycare. So they're going to get a nice break for those daycare expenses.
Now, is there any other steps that people have to take on their tax return to take advantage of these deductions, or is it automatic? Do most accountants automatically apply these?
Yeah, the accountants are still going to automatically apply it. How you file for it hasn't changed. So that
Okay.
piece of the tax code hasn't changed at all. It's just you've got increased income limits that are now going to be able to take advantage of these credits. And a larger percentage of it's going to now be able to be deducted. So what that's going to
Okay.
do is put more money in people's hands to do things with.
And that's always what we want. We want to keep more of what we're making rather than spending it on taxes. Now, we
Absolutely.
work with a lot of different generations from Gen Z, Millennial, Gen X, Boomers, and we always like to tell people the strategies that they can be using to really benefit the most in their generation or the mistakes to avoid that their generation is making. And being a multi generational company, Union Financial, we do like to share that there's different strategies depending on where you're at in life. And so I want to discuss the way this bill is going to impact those different generations from Gen Z all the way up to boomers. And of course, there's going to be some overlap, but any standout impacts that you see Gen Zs should be mindful of, or millennials, those that are a little bit on the younger side and maybe just getting started in the workforce, what can they be mindful of in terms of the benefits from this bill?
It's going to make a difference whether you have children. So we talked about a lot of the big breaks you're going to get if you're young, you have children, you're trying to start your family and raise it. So whether you're Gen Z or whatever category you fall in, if you have young children, this bill is going to add a lot to benefit you. The other thing that it's going to impact is depending on the type of job or work that you do. So one of the big things is no tax on tips.
Mm,
So if you're in a type of employment where you're receiving a good portion of your wages in tips, 25,000 of tips will not be taxed. So you won't pay income tax on it, but you still are going to have to pay your Social Security tax.
mm,
That's a huge break for somebody who's in that line of work. The other big break is for those that are in employment where you have a lot of overtime.
mm.
So if you're filing single, $12,500 of overtime compensation will not be taxed. If you're married, that overtime jumps to 25,000. That's not going to be
Wow.
taxed. The biggest thing to keep in mind, it's not 100% of that income you make in overtime. It's the extra. So let's say your pay is $20 an hour and your overtime is $30 an hour. That extra 10 you're getting in
Mm,
overtime pay, that's the portion that you're not going to have to pay income tax on. Still pay Social
okay.
Security, but you won't pay any income tax. So for people in that line of work, they're going to get a big break when it comes to saving money on taxes.
That's huge. I mean, I know personally one of my really good friends and clients is a police officer, and he works a lot of overtime. He's in the process of starting a family right now. And so they're looking for every extra dollar they can find. And so he's working a lot of overtime. And if he can save money on taxes from that overtime and keep more of that, maybe he can put it towards an account for his newborn baby or something that can benefit his child's future. And so the impact just starts snowballing at that point when you really think about the money that you're saving on taxes and where you can put it to use. That's awesome. That's
Oh,
exciting.
Yeah, absolutely. I think that's one of the nice things about the bill. You take a look at these young people out there really trying to do the right thing, working hard, and just feeling like they're struggling to get ahead. I think this bill's going to help. Now, for the older generation, those over 65, they're getting an extra $6,000 deduction. So their standard deduction is going up an extra $6,000.
Mm,
Now, this doesn't mean whether you just take the standard or whether you itemize. Every individual over 65 is going to get an extra $6,000 of deduction on their taxes. So for the older generation, it's going to put more money in their pocket also. And that creates some planning opportunities for that segment of the population as well.
Is Social Security going to be taxed? Because that's been a massive question. And I think something that both political parties were discussing in all the debates that they would end tax on Social Security. Has that happened yet, or is it still in the works?
I think it's more about the terminology. So there was no elimination on tax on Social Security. What the extra credit is designed to reduce the amount of income that you pay tax on, which in turn can reduce the amount of Social Security that's subjected to tax. So there,
Okay.
in order to eliminate the tax on Social Security, it would have required Congress to vote on that. So instead of doing that, they added this extra credit in, which in turn kind of does the same
Mhm.
thing. When you look at your bottom line tax, it's reducing your overall tax, which I guess could be equated to, oh, well, it's reduced tax on Social Security. But in reality, it just reduced tax on all of your income.
Okay, so it's a baby step towards reducing tax on Social Security. We're not 100% there yet, but the seniors will be saving on taxes. So it's a baby step.
Yeah, because when you look at if you had a couple that didn't pay tax on Social Security because where their income was, but they still had income tax, this just wiped out some of that.
Mm,
So it can benefit those that maybe didn't have enough income to where they were paying tax on Social Security. It's going to reduce their taxable income. For those that had 85% of their Social Security subjected to tax, it's also going to reduce the tax amount. So it really benefits
okay.
anybody over 65 who was paying taxes.
Okay. All right. Well, that's a good thing. Now, another thing that could benefit the younger generations that have young children or are thinking about having children, talk to me about these Trump accounts that haven't officially launched yet, but I'm personally really excited about the benefits that this could provide young families and their children. So tell me a little bit more about that.
For anyone who had a child born in 2025, starting in 26, you can apply and have $1,000 added to your account. And then you can contribute up to $5,000 a year into the savings account. It continues to grow tax deferred. And if it's used for um, qualifying items, it comes out tax free when you are 18. So you get 18
Mm,
years of deferral on this. If it's used for education, if it's used for trade school, if it's used to purchase a home, that all comes out tax free. So
wow.
this is a um, huge benefit to save for your children to try and get them a step ahead when they turn 18. But it's a huge benefit. If somebody puts $5,000 a year into this account for 18 years, even if it grows at a modest 6%, that's $150,000 that have been accumulated by age 18,
Wow.
um, which is a great way to set an 18-year-old up for
Mm.
education. They can start a business. I mean, it's deductible for that. There's just a lot of nice things that it can be used for.
So that whole 150,000 will be considered tax-free essentially at 18 if it's used for a business or education or buying a home.
Absolutely.
That's
So if
amazing. What a great jump start.
it is, and it really works in conjunction with the 529 plan. So the 529 is an education account. They've also expanded that to be used for K through 12. So you can use it for younger kids, K through 12. You can let this other Trump account grow, use it for college, or use the two in a combination. And then when that child graduates, they may have money sitting in that account to purchase a home, start a business. It's really a lot of neat things that can be done with those
Mhm.
funds.
That is great. And I know the laws around 529 plans have changed. Obviously, you said they expanded them to be able to be used prior to college. They could be used for private school, charter schools, K through 12. But talk to me about the other really cool benefit that you can do with a 529 plan to convert that into a Roth IRA.
That's one of the neat features of the 529 plan. Um, I think some of the great things if you don't use the money, you can let it continue to sit and you can pass it to your children to use for education. So it's a generational thing.
Mhm.
Or you have the ability to take up to $35,000 out of that 529 and use it as a Roth contribution. So if somebody hasn't used it all for education, they want to move it into or part of it into a retirement account, they have the ability to do that by pulling it out and putting it into a Roth account. So that's another really nice feature that the 529 offers.
And for our listeners that aren't familiar with a Roth IRA and how that works, essentially everything that comes out of the Roth IRA in retirement, including all the interest earned, you start it with $5,000, let's say it grows to $50,000. That entire $50,000, including the $45,000 in interest earned, is available to you tax-free. You're essentially removing that money from the tax system forever. And that's why they put a limit on how much you can contribute to one each year, because they don't want all of the money moved out of the tax system. But it's a huge benefit, especially for those that are young, because you have all of the years for that money to grow and compound and increase your overall tax savings in the future. And the other reason, too, is that we don't know what the tax rates are going to be 10, 20, 30, 40 years from now.
Yeah, I've always looked at the tax code kind of as a board game. So when you get to be age 65 and you're starting to live off the money you've accumulated, you need to know the rules of the game. So having different buckets of money, Roth money, traditional money, regular investments, allows you to determine where to pull the money from depending on the changes to the tax code. For young people, Roth is absolutely one of the best accounts they can put money into. As you mentioned, it is going to grow tax free. It's going to come out tax free as long as you're over 59 and a half. Other things about Roth income under the current tax code that creates an advantage is currently we do calculate Social Security to determine how much of it is going to be taxable. Roth income does not count in that calculation.
Mm.
Also, when you retire, depending on your income, your Medicare Part B premiums can be increased if you have too much income. Roth IRA income does not count in that calculation. Where
Mm.
traditional IRA 401k income is going to be part of that calculation. And not only are you paying tax on the withdrawal that comes out, but it can cause you to have more of your Social Security subjected to tax, can cause your Medicare B premiums to go up. Roth income, currently, that is not in the calculation. So it is
Mm.
huge. And for the younger generation, especially if you have kids, you may be in a very low tax bracket. An example, if we take a look at, let's say you have a married couple, you've got a spouse making $25,000 in wages, $15,000 in tips. You've got the second spouse, 50,000 in wages, 8,000 in overtime. They have two children. They're spending $15,000 a year in childcare. Under the current tax code, that couple would not pay any federal income tax.
Wow.
The deductions, the child credits, everything would wipe that out, and they would end up getting a refund of $1,038 approximately. Under the new bill, with the break you get on overtime, the break you get on tips, that same couple now will see a refund of $7,120. So that's a
Wow.
huge difference. If they can take that money and put it into a Roth IRA or a Roth 401k, they are not paying tax on that.
Mm.
So they are getting a contribution going in
Wow.
that they've not paid tax on. It's going to grow tax free, come out tax free. Best scenario you could possibly have.
It's getting tax advantages on every side.
It does. So if you are in a situation like that where you literally are not paying taxes and you have the ability to take advantage of a 401k plan, if they have a Roth option, that's the place to put it. From our planning standpoint, we've always looked at if you're in the 12% bracket, which is about approximately 98,000 of taxable income. If you can put it away at 12% or less, you're much better off to put it into the Roth.
Mm.
Because the day will come, your children are grown, you've got basically no deductions anymore, you're in your peak earning years. That's the time you really need to take advantage of the pre-tax and
Hmm.
get those tax deductions when you're in that highest bracket in your lifetime. So for young people,
Yeah.
not only are you getting it in at a low tax bracket, but the compounding of interest over all those years is just going to make a huge difference when it comes to retirement.
So, a good suggestion would be as we get into the 2026 tax season, if anyone receives a refund after they file their taxes, that should absolutely be invested into a Roth IRA for your future.
I completely agree with you. I think that's one of the best
Hmm.
things they can do with it.
Okay, that's amazing. And let's talk real briefly about doing a Roth conversion during this time. Maybe that could be for the Gen Xers who are not quite in retirement. That seems to be the sweet spot to do the Roth conversion to benefit their future while also not creating a huge tax burden right now. Tell me just a little bit about what a Roth conversion is and maybe an example of what you're doing with your clients, Todd.
Yeah, so a Roth conversion is just taking the traditional IRA money and deciding that I want to convert it to the Roth for the long-term benefits. You're going to pay tax on it the year you convert it. So if somebody has 10,000 in a traditional IRA, they determine they want to convert it to a Roth, that 10,000 is going to be added as taxable income. So here again, if you're in that lower tax bracket, it may make sense to do that from a long-term planning standpoint because that's $10,000. If it's growing at 7.2% interest, it's going to double every 10 years.
Mm.
So that's a huge compounding of tax-free money when you take a look at the tax you may pay today to have the ability to not pay tax on it in the future. And also keep in mind,
Yeah.
some 401ks now allow you to do conversions inside the 401k. So if all of your money is in a 401k and you don't have it in individual accounts, check with your employer to see if they have an option to allow you to do that.
That's interesting. And what I just heard you do was use the rule of 72. And that's something we've never discussed on our podcast before. Can you share what that is? And I think our listeners will enjoy that.
Yeah, so if you're talking about how long it takes money to double, you can just look at if I'm going to get 7.2% interest, 72 divided by 7.2 is 10 years. That means your money is going to double every 10 years.
Mhm.
If you're getting 10% interest on it, it's going to double every 7.2 years. So just divide it by 72, and that'll give you the doubling effect. It's just a simple terminology,
Okay.
a way to calculate quick growth on money.
That's pretty cool because everyone wants to double their money. But how long will it take? Let's be realistic here, you know?
Well, yeah, so like that 10,000 conversion, if you've got 30 years to retirement, it's going to double three times. So the 10 goes to
Mm,
20, goes to 40, goes to 80.
wow.
So that conversion, when you look at the compounding and the doubling, it gets huge.
That is huge. Now, another thing that I have heard a little bit about, but I don't know the details, is some of the tax breaks on buying new cars that are produced or finished in the USA. And how will that impact the average American? Tell me a little bit more about that.
Yeah, so what it's going to allow you to deduct the interest on the loan. And one of the advantages is you don't have to itemize. So even if you're taking the standard deduction, you're going to get a break on the interest you paid on that loan. It just, the assembly needs to finish in the United States. There is a website you can go to that will help determine which vehicles are eligible
Mm,
for this. And I would assume the car dealers should be able to tell you that also, as long
okay.
as they're being honest and ethical. Um, but there are some nice breaks on paying interest on that loan. It just has to be a new vehicle. So you can't do it on a used vehicle.
We'll put that website in the description below for our listeners to check out. But I mean, if you're in the market for a new car anyways, why not save a bit on the taxes on the interest part of that loan? It's
Yeah, it's a way
if
to
you're buying it
promote
anyways, it
yeah,
helps.
promote buying America.
Exactly, exactly. Now, in your opinion, does this bill help narrow the gap between the middle class and the upper class, or does it widen that gap? I mean, we're talking about the average American, and is this actually going to make a difference, in your opinion?
Well, it's not so much what the bill does as far as narrowing that gap, it's what people do with the savings.
Mm,
So the example I gave with that couple getting an extra over $6,000 in tax refund, it's what they do with the refund is what's going to help narrow that gap. So if they turn
mm,
around and put it aside for retirement, then yes, that is going to help narrow that gap because it's now allowing them to save that extra money that they weren't able to save before. If they just go out and spend it's going to do nothing to narrow
mm.
that gap. But it
Okay.
is putting more money in people's pocket that is going to allow them to create additional savings. And in the long term, that will help narrow that gap.
Okay, that's exciting to hear. And now, before we wrap up, what would you say would be a myth or a misunderstanding around this bill that you keep hearing? And what's the real truth behind it?
I've heard people say, well, they're going to be kicking people out of nursing homes. Um, that's that's not
That's
true.
random.
Yeah, very random. Well, they're going to kick people out of nursing homes. No, there's nothing in the bill that affects Medicare or Medicaid benefits for those over 65. Those from 19 to 64 that are receiving Medicaid, they have some requirements now. You need to either 80 hours a month in either an employment, community service, or education. If you're
Mm,
unwilling to do those three things and you're able to work physically, you're not going to get a benefit.
okay.
So those are the people that are going to be impacted. If you're disabled, medically you can't work, you're still going to get benefits. It's not going to impact you. So I think that's one of the myths. The other is that this bill only impacts the wealthy. If you look at where a lot of the phase outs go into place, this is really, it's designed for the middle class. It's designed for married couples, singles that fall into that middle class category. They are going to reap the biggest benefits from this. Those
Mm,
making $400,000 or $500,000 a year, there's not much in this bill for them because all the phase outs can go into effect. So it's really, in my opinion, it's for the middle class. So I think those are the two biggest misconceptions is all these people that are going to be thrown out of nursing homes um, or that this bill just benefits the wealthy. I, I don't see that in the bill anywhere.
okay, well, good. Thank you for adding some clarity to that. Anything else that you want to share, Todd, about the way you're helping your clients or any strategies that you're using right now that you think you'd like to spread a bit of awareness about?
I think the biggest thing is, having awareness of what the tax code is and understanding how that can impact your client. Just like you mentioned, taking that refund, putting it into a Roth IRA, that's great planning. That's going to help create additional wealth for people that maybe couldn't before. So those
Mhm.
are huge advantages. In working with people over 65, I really think with this extra 6,000, 12,000 for married couples, it creates additional opportunities for Roth conversions. That helps create a nice legacy bucket for
Mm,
the next generation that's going to save them on taxes and receiving that inheritance. So there's a lot of nice things in this bill from a planning standpoint.
Absolutely. Thank you for sharing everything. And I hope our listeners got a bit more clarity and we should be excited. We're going to be saving on taxes. We have more opportunities to invest those tax savings and opportunities for the next generation as well with some of the updates for the 529 plans and the quote unquote Trump account or whatever they're going to call it. That could really help the next generation be even better than the current one when it comes to saving for their future. And for anyone that's listening and you're in the Midwest area, I'd encourage you to get in touch with Todd from Excel Wealth Management. I'm sure he could review your current plan, or if you want to ask a few more questions about this legislation or any future ones, he's always a wealth of knowledge. And if you're in either the Tampa Bay area or we serve New Jersey, Pennsylvania, up and down the East Coast, and you have specific questions for our team at Union Financial, feel free to go to our website, union-financial.com. You could schedule a meeting. We always offer complimentary meetings. And you can just click the schedule a meeting button. It'll take you right to our personal calendar. But that's pretty much all we have for today. Todd, thank you so much for coming on and helping us unpack this in a way that actually makes sense. And I always like to say that, policy can shape your paycheck, but decisions are what shape your future. And that's what our job is as advisors. So thank you, Todd.
Thank you, Marissa. I've always enjoyed your podcasts, and it's fun to be on one. So I appreciate it. Thank you very much.
I think you'll be on future ones or maybe start your own at some point.
I'm not
Never
sure at
know.
this stage of my career I'm ready to do that.
It's never too late. Well, for everyone that's watching, thank you all for tuning into another episode of the Future of Finance podcast. I'm your host, Marissa Wood, and we look forward to helping you live a better financial future. Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Union Financial Services are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by Marissa Wood and guests on this show are their own and do not reflect the opinions of this radio station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and otherwise stated are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it's suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to subject covered. Index or fixed index annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charge as described in the annuity contract. Guarantees are backed by the financial strength and claims paying ability of the insurer. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.